this document could cost you or save you thousands of dollars. But most homebuyers sign it without really understanding what they're looking at. So let's change that. Have you ever heard someone say, my lender originally quoted one number, but suddenly my cash to close was way higher at closing? Can lenders legally do that? Sometimes yes, sometimes absolutely not. And the key to understanding what changed starts with this document right here. This is the loan estimate. And in this video, I'm going to show you the most important parts of the loan estimate, which numbers matter most, and what you should pay attention to before you ever get to the closing disclosure. The loan estimate is required by law. The lender has to provide it within 3 business days after you apply for a mortgage. It'll most likely be sent to you along with about 50 other pages for your e-signature in the loan application and disclosure package. So sift through all that and find this one. This document is designed to help you understand your loan, compare lenders, estimate your monthly payment, give you a reasonably accurate estimate of the cost to close the loan. Now, one important thing to understand right away, this is an estimate. Some numbers are very tightly regulated and aren't supposed to change much at all, but others can legitimately change later during the process, depending on things like when you lock in your interest rate, what the price of that is, your insurance costs, just timing changing on the loan, other changes to the actual loan type or structure. So we'll talk more about those rules later in this series, but first, you need to understand what you're actually looking at. Page 1 gives you the big picture snapshot of the loan. This is where most buyers first look at the interest rate, the monthly payment, and the cash needed to close. So let's break this down section by section. At the top, we have the property information, the purchase price, the basic details of the loan itself. You'll see the loan term, loan type, whether the rate is fixed or adjustable, and whether this is a purchase or a refinance. Now, this section right here is extremely important. The rate lock. Is the interest rate locked or is it still floating? And if it is locked, how long is that lock good for? Because mortgage rates and the cost of those rates can change daily, and that can affect both your monthly payment and your closing costs later. You'll also notice another expiration date lower down. That's referring to the estimated closing costs. By law, those estimates generally have to remain accurate for at least 10 business days. And once you officially tell the lender you want to move forward, that's called your intent to proceed, many of those fees become much more restricted from changing. We'll talk more about those fee rules in another video, but for now, just remember this document is important. In this example, this is a 30-year fixed mortgage. That means the principal and interest payment itself will not change over the life of the loan. There's no prepayment penalty. There's no balloon payment. Now let's take a look at the middle section. Buyers usually care about this the most. It holds the monthly payment. Now this next part is important. The total monthly payment is going to be higher than just principal and interest. Because this buyer is putting less than 20% down, there's mortgage insurance included. Now, mortgage insurance works differently depending on the type of loan. But in this example, this is a conventional loan. So the mortgage insurance is not permanent and is scheduled to fall off later once enough equity is reached as they pay down the loan. Then we have estimated property taxes and homeowners insurance. Many lenders collect these monthly and place them into what's called an escrow account. Although escrows are sometimes optional depending on the loan and amount of equity, they are going to be included here in this section because they're part of the true monthly housing cost of owning the home. So if you have an escrow account, when taxes and insurance come due later, the lender can pay them on your behalf from the escrow account. And this right here is the actual estimated total monthly housing payment. This is the number buyers really need to feel comfortable with. Now, at the bottom of the page, let's look at another very important number. This is the estimated cash to close. This is approximately how much money you'll actually need to bring in to purchase the home. And this is where many buyers can get confused because the closing costs and the cash to close, they're not the same thing. Cash to close usually includes your down payment plus your closing costs minus any credits or deposits that have already been paid. And notice here, the closing costs themselves are split into two categories. We've got loan costs and we've got other costs. So let's go over to page 2 because that's where all these details are broken down for us. This page is where all the detailed costs are disclosed, and honestly, this is the page most buyers never fully understand. But once you break it into sections, it becomes much easier to follow. The left side contains loan costs. These are costs associated with getting the mortgage itself. Things like lender charges, points, underwriting, appraisal fees, credit reports, title-related services that are going to be required by the lender. This top section right here, Section A, is especially important when comparing lenders. These origination charges, no matter what they are called in the breakdown below, are the fees you are paying to the lender. This is where you'll typically see things like points, underwriting fees, processing fees, any other lender-related cost. And lenders can sometimes get pretty creative with the names of these fees. So when you're comparing loan estimates, this is one of the most important sections to pay attention to. This first line shows the estimate because remember this loan is floating, not locked. So this is the estimate at the time of this disclosure for that rate of 6.25% we saw on page 1. That cost is 0.25 or a quarter of the loan amount or $11.87.50. For comparison's sake, if the points were 0.5 or a half a point, that cost would be $23.75, or 1 point, it would be $47.50. So look at this section carefully. You may be pleased to be getting that rate at 6.25%, but make sure you aren't paying too much in points for that rate. The other thing to look at here is the other lender fees. Now, it's very typical to see underwriting, processing, application, or other similar fees in this section. But just compare these as well, because sometimes a low advertised rate gets offset by higher lender fees hidden in this section. If we did a little math, we would see these fees themselves equal 0.44%. That's almost half a point. Again, it's not untypical. Just be aware it's part of the total cost. One last thing to consider when you're strictly comparing your total lender fees and costs, at the bottom of the total cost on the right side of page 2, after all costs have been totaled, if you were getting a credit from the lender, it would show up here. This could, of course, offset some costs from that Section A we were just looking at, so just keep that in mind for total comparison. We'll go over these rates and point costs versus the lender credits in another video. Next, under Loan Cost Section B, we have services you cannot shop for. These are required by the lender, but provided by third-party vendors the lender works with, so not paid to the lender. There won't be any hidden fees here. What the credit company charges for the credit report is what you will pay for the credit report. Then last, under loan costs, we have Section C, services you can shop for. So we have title fees in this section. In a purchase, the seller's already selected a title insurance company. If the seller's paying for your title insurance policy, that's very common, it makes sense to get your lender's policy here as it'll just piggyback on the owner's policy. But you do have a legal right to shop around for fees listed in this section. You might also see land survey or perhaps inspection fees listed here. But again, you can shop around for these services and the lender has no control over these fees. The right side contains other costs. These are costs tied more to the property than the transaction itself. There's things like transfer taxes, recording fees, homeowner's insurance, prepaid interest, escrow setup account, that kind of thing. So under prepaids, this is, for example, your new homeowner insurance policy. That first year needs to be paid in full at the time we close. Also, any property taxes due or coming up due, you need to pay at closing. Now, in Colorado, taxes are paid in arrears. That means that taxes for 2025 are paid in 2026. So on a purchase, the seller would, of course, be paying any taxes due in the current year for the prior year. The one item that surprises many buyers is prepaid interest. Mortgage interest is also paid in arrears. Each monthly payment you make covers the interest for the month just completed. The only time you pay interest ahead of time is from the day of closing till the last day of that month that you are closing in. This next section, initial escrow, as we just discussed, the seller pays property taxes due for last year, but you would have some costs here to set up the escrow account. So next year, the funds would be available when taxes are due. And of course, the cost for escrow setup for homeowner insurance. Now, here's something extremely important. Not all fees are treated the same under mortgage regulations. Some fees are basically locked in. We talked about earlier your rate and is it locked, as well as the expiration date for those other costs. Some fees can change a little, and others can change more freely because the lender doesn't fully control them or control them at all. We'll go much deeper into those tolerance rules later in this series because understanding them is one of the best ways to protect yourself from unexpected fee increases. Later in the loan process, you'll receive another document called the closing disclosure. That's got the updated version of all costs and figures before closing. Now, one of the smartest things buyers can do is compare the closing disclosure back to the loan estimate to see what changed, why it changed, and whether those changes really make sense. The loan estimate is designed to help you clearly understand the loan terms, your monthly payment, and the closing costs so you can make sure you're comfortable with the loan before you're moving too far forward with this loan and this lender. The more comfortable you are reading this document, the more confident you're going to feel throughout this whole home buying process. In the next video, we'll compare the loan estimate directly against the closing disclosure line by line and explain exactly why certain numbers changed. If you found this helpful, make sure to like and subscribe and let me know in the comments what part of the mortgage process feels the most confusing.